So Shell Trading has been marketing crude in Angola for many, many years, but mostly on a spot basis. However, in the last few years, we have been really focusing on developing structural positions. Structural positions meaning longer-term arrangement that create a continuous and regular flow. Now, the Angolan oil and gas market, the upstream market in particular, has been historically led by oil majors and the state oil company, Sonangol. A little bit of indigenous companies in the shallow water, but really the core of the business has been deep offshore with majors and Sonangol. However, in the last few years, we have seen a number of divestments start, a first wave of divestment in country, the very first one. And that has given the opportunity for independent companies to buy some of these mature assets that were sold. At Shell Trading, we have been working with a number of these companies. We have been supporting them, including financially, and that created that logistic position that we were talking about, because now we lift from quite a few of these Angolan export terminals, and we have that logistic position. Now, these trigger a few considerations. The first one is that independent companies that lift with us, and also for prospective companies that want to work with us in the future, they will have their lifting more often. So we optimize their cash flow, because instead of waiting for a full cargo, they can aggregate their production with other entitlements, and we lift more often. So it means they get cash flow more often, they can repay their loan sooner, they pay less interest, and if they have free cash flow, they can also pay dividends more often. So it's a big upside. Freight cost, that's also an important upside, because by lifting full cargoes rather than part cargoes, we save quite a bit of money for them on freight costs, so that's a good one too. And also price management, by spreading your lifting throughout the year rather than just once in a while waiting for a full cargo. That optimizes the price risk. You don't put all the eggs in one basket, and maybe in that time when you lift you have a low oil price, but you are spread throughout the year, and it's a sort of free hedging that is given. This is a major value proposition that we offer to third parties, and I think very few traders can do that. Well, first of all, it's no secret that a lot of international banks and financial institutions have reduced their presence in the oil and gas market, some of them even completely withdrawn. Traders have been called in to bridge that gap, and I think the support of the traders have been quite important, especially in the last few years, financing operations of producers and also supporting with growth. And that's both organic growth, financing capex and drilling campaign, but also inorganic, like acquisitions. Now, Shell Trading has been indeed working by deploying its own balance sheet for supporting independent producers in that. But also we spent quite a bit of time in developing a relationship with alternative lenders that can bridge that credit gap. And that means development financial institutions, funds, private capital, regional banks. And all of that, I think, is a great combination. So Shell Working Capital plus finding the right lenders that can join our facilities and support independent producers. We see compliance as a very important value. It's very much on top for us, at the same level of HSSE. And when we work with third parties, it doesn't matter if it's an oil major, if it's a small startup, we expect the counterparty to have the same view on compliance. And we also spent quite a bit of time trying to encourage and guide, especially the new companies, independents, to invest into compliance. Of course, it is a cost to set up a compliance team, to be audited, to issue compliance policies and make sure that all of the staff understand the policies and follow them. But we see that as a very good investment, and one of the reasons is that once a company reaches that, let's call it international compliance level, in line with international banks, large corporations, all of a sudden it becomes more bankable. A lot of lenders that wouldn't probably talk to the company before, they might be interested in deploying capital. And so it means more funding, cheaper funding, and the same, by the way, applies also to equity. So if you want to raise equity, reaching a good level of compliance, I think it's a key requirement.